I've been doing margin for about 2.5 years now. And even prior to that, my parents, they have an investment property, mortgage from a bank as an
Yeah.
investment property. Even your principal mortgage, all of that is margin. That's not necessarily margin, but it's
Borrowed
borrowing.
money.
Everything is borrowed money. Well, guess what? The world runs on debt.
Yeah.
So that's not gonna go away.
Yeah.
Guess what? The wealthiest
Does it
don't
have
buy
to-
stuff with their own money. They buy stuff with other people's money, and they write off the difference.
Exactly. It's like Elon
It's
Musk.
the same thing.
He bought Twitter with all his.
It's just the amount of
That's
scale.
legit.
It's just the amount of scale you have access to is different, but the concept is more or less the same. You need to think. It's all from a mindset perspective. You need to think. You need to think like the wealthy in order to become wealthy. You can't have a broke, poor mindset and think you get wealthy by having that same mindset. Guess what? You'll stay in that bubble.
Yeah.
You'll stay where you are.
Yeah,
your
you
mindset changes and adapts when you move up in that social ladder. It has to. Otherwise, you're going to be doing the same thing over and over again, and nothing's going to change.
Yeah.
Right? If you don't adapt your mindset, even if you get money in that account, if you don't change your mindset and adapt to your environment, to different market conditions, well, guess what? You're no different than just pulling out everything during a market correction and selling it and using it and then storing it off in a bank, and you're losing power because inflation is so high. You're effectively just losing buying power. And guess what? In retirement age, if you don't change your mindset and do what is beneficial now, you're gonna be broke ass for the rest of your life. You're gonna be working until you're 100 years old. You're gonna be forced to work until you're 100 years old, not by choice. You have to in order to survive, because everything is gonna get even more expensive moving forward. Inflation is gonna keep going up.
Yeah.
It's not gonna go down.
Your paycheck.
Guess what?
Not enough.
The world is run on debt. Everything gets more expensive. Everything loses buying power every single year. Well, you need to get with that game. You need to do the same thing. You need to invest with debt if you're able to, in order to keep up with the game and do more. Otherwise, you will be staying at that same bubble and nothing will change. And guess what? That's your fault.
Yeah.
That's your fault, basically, for not changing your mindset.
We got some good
Right? That's a wake up call. It's a wake up call. You have to realize it now to change and better yourself, better your family, become more financially aware of what's possible. Because the end result, the end benefit is you and the closest people that you are with. Welcome, YouTube. So this is the first episode of Beyond the Paycheck with your co-hosts, Convos with JJ and Leon from Leon's Money Flow. So essentially, this would be an ongoing monthly series where we talk everything about tax efficiency, about margin investing, using how to use margin efficiently and effectively for your own investing needs and risk capacities that you're able to tolerate, as well as any sort of optimization that might be required within your overall financial portfolio, and anything else that may be relevant to new viewers and ongoing subscribers. So once again, I'm JJ, one of your co-hosts, and I also have my fellow co-host from Leon's Money Flow. So Leon, why don't you start the audience with our first topic of the day?
All right. So our first topic we're gonna dive into is a little bit about margin.
Let's do it. Hot topic, right?
Yeah. So JJ actually has more experience here. You've been doing margin for how long?
I would say about in total almost 2.5 years now, since late 2023 actually.
Cool. Yeah.
Yes.
And then so yeah, JJ's been doing it for that long, and then I just recently started using some margin, which was kind of like recommended, or like I followed people, Jordan from Cover Call Investing's doing it, and you were doing it, and so a bunch of others were joining in.
Paul actually from Better Call Paul also opened their margin account along with their fellow co-creator Sean. which
exactly.
is also known as After the Dividends on the Blossom social investing app. And then we also have Robin Haney, who is
Yeah,
actually also doing it as well, whereas his portfolio is more or less structured. I would say about 20% focus on cover calls in their own margin portfolio,
yeah, he has
and
some growth.
70% more focus on growth and dividend growth per se.
Yeah,
So Leon, so what made you interested in starting margin now? And yeah, let's just give the reviewers a little bit of a spiel of your whole
yeah.
thought process.
So I wanted to start with margin,
Hmm.
just trying to dip my toes in and get a feel for it. So I wanted to like basically bring in more dividends.
Hmm. Okay.
Like try to maybe speed up my compounding with
Okay.
that and see
Okay.
how
Okay.
it works. Yeah, and so far I've been enjoying it. So
All right. And so before we actually go further, just for viewers' discretion. So both myself and Leon are not licensed financial advisors. I am
okay.
currently in the process of obtaining certain certifications that allows me to offer this kind of advice down the line. But as of this current moment, we are both not licensed financial advisors. So viewers, please take in mind this is only for entertainment and educational purposes. So follow along with our content with a grain of salt and make sure you do your own due diligence before delving into, say, hot topic, and be be mindful of your own risk tolerances and risk capacities per se. So I'll just give a little bit of definition differences. Risk tolerance is your emotional capacity of handling downturns and market corrections, which is what we've been sort of experiencing in the past 2 months or so. And then risk capacity is not psychological, but it's more so a set in stone quantitative analysis of how well you are able to recover any sort of losses from a deduction in your income. So that's like a mathematical calculation, whereas risk tolerance is more so focused on the emotional and the psychological plays per se. So yeah, Leon. So when it comes to margin, how well do you know what margin is, and what's your experience with opening a new margin account so far? Is this your first time? Let's just be a bit more specific. Is this your first time opening up a margin account, and whether or not you have other sort of related experiences when it comes to margin?
Yeah, it's my so I haven't had experience with margin before, so it's my
Okay,
experience
exciting.
with that. I've had it. I think I've used margin for a full month now.
Okay,
So I've actually gotten 1 month of dividends already.
exciting.
Um,
Okay,
yeah,
great timing then.
yeah. So my experience is just yeah, just from that month there.
So after this first month of opening up a margin account, how much have you roughly put into that margin account per se? How much have you borrowed against the broker? And what kind of holdings? Oh, keep in mind, viewers, that both of us are Canadian Gen Z investors. So our risks, our own risk capacities are and their tolerances may be different to your own needs and preferences. So just keep in mind that we are Canadian investors that are more focused on what is available and profitable on the Canadian side. So
Yeah.
Leon, let's go back to the question at hand. What kind of products have you actually sort of dabbled in so far, and what do you think is your mindset moving forward? Because that's what
Like my
no, that's what
holdings.
viewers really want to relate to for their own for their own journeys per se. Yeah.
You mean my holdings, right?
Yeah,
Yeah,
exactly.
yeah. So
Of course.
I I I'm kind of going with a uh conservative as much as I can approach. So
Okay.
that's why I have um like your traditional, or actually I've stay in there, which has 35 US, I'll just call them US champions, dividend
Right.
champions.
Okay.
Like yeah, the longest.
Just to confirm that you have the Hamilton Daymax US equity position
Yeah,
estate.
yeah,
Okay.
yeah. I have that. I have a little. HHIS.
Okay. Okay.
Just
Exciting.
that's probably one of the more riskier or growth oriented cover calls ETFs that I have in
Mm-hmm.
there. I
Sure.
have a big position that in Utes. Um,
Okay. The Evolve Utilities cover call,
yeah, so I
enhanced
like
cover call ETF.
yeah, so I have 400 shares of that.
Okay.
It's pretty stable. It's I think
Mm-hmm.
it's pretty comparable to I don't know. Would you compare it with bank-ish, like how
I would
stable
say
it is?
arguably speaking, if you're looking on let's specifically focus on because both bank and use are from the same provider
Yeah,
and more or less they share the same cover call strategy. So up to 50%
yeah,
out of the money covered calls. And bank specifically, let's go through the holdings. Bank specifically holds 10 life insurance companies and the top six banks in Canada,
yeah,
whereas Utes is focused on the utilities and energy sector. So arguably speaking, because they're from the same provider, they have the same cover call strategy, and they also have the same coverage. So the only and they also have the same management fee and more or less the same management expense ratio overall. So arguably speaking, the only difference would really just be the underlying holdings.
yeah,
So in terms of the sector allocation and and sort of the day-to-day movements per se, utilities is a way more defensive sector than the Canadian banks. Clearly,
mhm,
because if we remember properly, in Canada specifically, financials overall, which includes both the banks and the life insurance companies overall,
yeah,
makes up they are the number one sector in Canada, so which makes up the vast majority of the TSX 60. So they are a bit more growth oriented versus
yeah,
the utility sector.
yeah.
So
Especially the past
utilities
few
per
months.
se, it's very defensive. Usually in the past, during historical records, utilities is one of the main sectors where typical DIY and maybe sophisticated investors would probably switch over to during market corrections when tech crashes or corrects. So when that does happen, you'll see a huge spike in allocation in utilities in one of these sectors. So if that is the same case moving forward, but we also have to remember that historical trends don't necessarily indicate how the future could present. But based on what we know per se, just based on historical trends, utilities is usually a more defensive, more flat, more stable sector compared to financials per se. So if we go on that scale, from a total return perspective, technically, you would do better if you were in financials, aka bank,
Yeah,
in this case, and use is definitely more not necessarily a fixed income play, but
right.
it's almost fixed income like based on the fact that we also have covered calls on it, which already decreases the volatility of such a defensive sector. You know what I'm
Yeah,
saying?
yeah,
Yeah.
yeah. So yeah, what I more meant when I was saying it's like bank is yeah, it's like
It's
more
even more defensive than bank.
and it
Yeah.
doesn't move as much compared to your HHIS or your S&P 500
Mm-hmm.
fund or something.
Sure.
Um, but yeah, so I picked up that because at the time I was paying like a almost a 18% yield,
Yeah. So you bought it around the $9 range, give or take?
940.
943. Okay, so near its all-time high price, technically.
Yeah, something like that.
Okay.
Um, and then my margin cost is like almost 4%, right? So if so like theoretically if I do like
Are you just to clarify, are you a premium holder or a generational holder with Wealthsimple?
I am what is it? So
Premium
I'm actually less than
premium
100K.
so there's three different tiers with Wealthsimple.
I think
The
core,
core
yeah.
client is anywhere between $1 and 99,999. So below that $100,000 tier, which includes everything in Wealthsimple. So managed investing, DIY
Yeah.
investing, stocks, crypto, everything combined. that you're holding with Wealthsimple.
Yeah.
And so premium is when you surpass that $100,000 threshold and you're below that $500,000. So that's that middle tier. And a generational is anywhere above that $500,000 asset value. And then supposedly this is kind of focused on speculation. There may or may not be maybe another tier when you're at that $1 million plus range. We don't know if that's the case, but for now, those are the three different tiers that we have with Wealthsimple. And you can also see it for the fact that when it comes to margin borrowing, every tier that you go up, you get 0.5% less in terms of the interest rate that you're borrowing against when you use either the margin account and their new line of credit feature, which is still in beta, which was just launched, more or less.
Yeah. So I'm the lowest tier actually. I'm just a core.
Your core? Oh, okay.
Because I don't have all my funds in Wealthsimple right now. But I'm core, so I'm paying 3.95%, I believe.
Are you sure?
Then, so theoretically, if I yield 18% and stay stable, assuming it does that, and then subtracting 4%, that's still a solid 14%, right? Theoretically
Speaking, sure. Yeah. Let's go with that.
Well, that's why I went with.
But remember, nothing is guaranteed when it comes to investing. We're just purely based on the most probable event that could take place. Yeah. Nothing is guaranteed, but it's leaning towards guarantee. Yeah. It's a very gray zone, but it's a bit more guaranteed than, speculation per se.
Because they've been paying 13 cents 0.8 ever since they launched, yeah,
more or less. They've never really changed their dividend. Sorry, not dividend, distribution.
Their yield, yeah.
Yes. Yeah. Their yield, yes.
So yeah, same with bank, and then it's always been 11 cents.
Yeah, more or less. So just to clarify right now, so you have three different positions. So you have SDAY, you have USCL, and you have HHIS. Was there anything else? In that margin account?
BIGY.
You have BIGY in there. Okay. Very interesting. And just to clarify against investors, BIGY, so the BIGY that we're referring to, because there's also a BIGY listed on the New York Stock Exchange, which is the YieldMax top 50 US leaders cover call ETF, so the target 12. So that BIGY is from YieldMax. The one we're referring to is from Evolve, and that is listed on the TXX. And that one is more or less the direct competitor of HHIS, which is the Harvest Tech Leaders, Harvest High Income Shares, like the basket. And so BIGY comprises of 10 different holdings, more or less equal weight in the Mag 7, plus Coinbase, Strategy, and Palantir, as of right now that we're filming on December 7th, 2025. So yeah, with covered calls and up to 33% leverage, Canadian currency hedged. Is that correct? Yes.
I remember when they launched or they filed their prospectus and they said they had plans for a BIGY unhedged.
Yeah, they do.
And then a US.
I believe so, yes. As of this moment, I don't think
I don't think
the unhedged or the US dollar versions are out. I'm a little bit disappointed because if that were the case, I would be more inclined to be investing in BIGY over HHIS just personally, because I always prefer, if it were the option, the unhedged versions, because typically speaking, unhedged, you're more so tracking the US dollar.
Yeah.
And from a global economy perspective, long term, well, maybe not the case anymore, but we don't know. But US dollar still is stronger than Canadian from a overall economical standpoint. So which currency would you rather be hedged against, US dollar or Canadian? That is secondly a personal preference. But for me, I don't know about you, Leon, but I would personally prefer always go unhedged if that were the option.
Yeah, I like unhedged too. So I kind of forgot that point, but yeah. That's a good.
That's one main key difference between HHIS and BIGY. So let's just go to the differences. HHIS right now has 19 different holdings. You have Mag 7. You also have Costco. You have the Mag 7 holdings, and you have Costco. you have Robinhood, you have Reddit, you have Eli Lilly, so up to 19 holdings, mixed between the highest volatility US stocks and, more defensive like Google, like Costco, like Netflix, like I don't believe Berkshire, no, sorry, not Berkshire
Yeah.
Hathaway, but, a couple of
Broadcom.
stable holdings. Broadcom is in there as well, yes.
Yeah.
But then Biggie is, as of right now, they are limited to 10 different holdings. And so one
Yeah.
other key difference is Biggie can borrow up to 33% in terms of leverage. HHIS is capped at 25%. And the other main difference is HGIS is unhedged, so it tracks the US dollar, whereas Biggie
Yeah.
is hedged to Canadian, so it's more so following the Canadian dollar. What that means is when the US dollar is stronger, if everything else in perspective is kept the same, this is very theoretical, but if every other factor were the same, if the US dollar is stronger, HHIS's stock price would be higher, would be positive. But then if the exact opposite were the case, if the Canadian dollar is stronger when every other factor is the same, then Biggie would have a better stock price. We're only looking at stock prices. So Biggie's stock price would be
Yeah.
green, would be positive, whereas HHIS would be negative because the US dollar in this case would be slightly weaker. Yeah, just one other point to keep in mind.
Yeah.
So
Yeah.
as of it right now, so you have BIGY, you have SDAY, you have HHIS, you have CDAY. And is there anything else in
Not
that margin
C.
account? Oh, sorry, not CDAY. SDAY, Utes, BIGY, and HHIS. Is that
Yeah.
correct?
Yeah.
How
So
is the allocation in terms of percentage of your overall margin account, and how much are you playing around with that in margin account right now? It's a bit more. It's more specific in terms of numbers.
yeah, I actually don't know off the top of my head the percentage
Check
distribution
Blossom.
but the thing is, like, so my margin account was
Okay.
originally just my non-registered like cash account, right?
Okay.
So when I enabled margin on it, then technically like all my all my holdings that I had before in that account got transferred, but I
So you
didn't
did an in-kind transfer from your regular non-registered account to your margin account, basically?
I didn't transfer. I didn't do anything, so I don't know. Like, I'm not
Okay.
spending margin on them, right?
Do you have any? When you log into Wealthsimple under the margin tab, are you borrowing anything from the broker?
Well, yeah. Now I'm borrowing now because I bought like Utes and Peaches. Yes, since
Okay. Okay. Let's just keep it simple for in terms of like the user perspective, because not everyone has a margin account with Wealthsimple. Let's just keep it simple. How much in terms of your overall portfolio, like dollar value wise, is in that
yeah,
margin account, and what is the percentage between each holding? Let's just keep it nice and
yeah.
simple.
So maybe
From what you remember, yeah.
I think my available margin right now is like around 16K.
Okay.
And then I used, I think 4K now of
4,000.
my
Okay.
margin.
Okay, sure.
So I guess I would have 20K if I didn't use any margin in that ballpark.
Oh, no, sorry. I wasn't asking how much margin you have available. I was asking in that margin account, what is the total portfolio value of all your holdings added up together? We're not talking about how much you can borrow from the bank. We're talking about your actual portfolio size in that account.
I don't know percentage. I know it's like, I think it's around 27K.
27,000 in total? Okay. So
My total is like around 75K.
75. Okay, so you have $27,000 in your margin account out of your entire $75,000 portfolio
Yeah.
with
I,
Wealthsimple.
yeah.
Okay. 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 And then so in terms of that $27,000 allocation, how much is in each holding? Is Utes, let's say, is Utes about 40% of that allocation? Is Utes about 20% of allocation? Or are each holding more or less, equal weighted?
I need check Blossom.
Okay, sure. Let's do that.
what's personal? Is that my cash account? Yeah.
Personal is your cash account / your margin account, and that would just be your margin account if that is your only non-registered account with margin or
Yeah.
with Wealthsimple.
So
So it would be that.
so it's actually 28, but yeah,
Close enough.
close
Yeah.
enough.
Or we're ballparking within the error, like with the margin of error.
Yeah. So sorry, what was the question? Like you wanted to know the
The allocation of each holding in
each.
terms of like roughly percentage wise between the 4 different account types, the 4 different holdings.
Okay. Well,
Sure.
this includes the holdings that I had before I enabled
Doesn't matter.
margin.
So like just your your entire allocation.
Yeah. So in my personal account or this non-registered account, I have like around 40% BIGY.
40% Mickey. Okay.
13%
Okay.
Utes.
13%. Okay.
10% HHIS, 10% SDAY, 8% QDAY, and I had 15% MSTE.
You have MSTE on margin? Okay.
No, so I had this account, so like I don't know. I guess I need to understand, like I didn't use margin to buy it, but I guess it counts towards.
So okay, let's go through like the basically what happens when you open a margin account. So this is what I went through when I opened the margin account back in November of last year. So what happens is even though as soon as you add money to that account or you link your TFSA as collateral to your account,
Yeah.
what usually happens is Wealthsimple you will actually use your own money first to buy everything.
Yeah.
So that's what happens. And then as soon as you run out of money, and then that's when you start borrowing the broker's money.
Okay. Right.
So in your case specifically, everything that you had previously, I'm assuming you had MSTE, that 15% allocation MSTE, which everybody is probably familiar what MSTE is. If people know what strategy is, with its recent downturn of about probably 30%, I just say. Is that accurate? Probably. 30%, 40% in terms of stock price.
Maybe.
So MST, okay, 50% then in terms of stock price decline. That's probably what it is at right now. So that 15% in MSTE, I'm assuming you're 8% in QDAY, and did you buy BIGY on margin? Or did you already have BIGY previously?
I had some BIGY before and then some with margin.
Okay, so let's just say half and half. So that allocation of what you had, that QDAY, that MSTE, and that BIGY that you had previously, when that got ported over, you still own that portion. So you're not technically borrowing that portion in your margin account, but that will contribute to the amount of margin you have available. And that will dictate, because if I remember correctly, is MST at 50% margin requirement or 75%?
Increased from 30 to 40.
Is that 40%?
Yeah.
For a single stock ETF. For a single stock cover call ETF, it's at 40%. It's not even at 50. I'm surprised 30. I'm surprised it's not at 50% or 60%.
Yeah.
Because it's so high risk. Why would you buy this? The broker should basically dissuade any everyday investors who are not that savvy in terms of borrowing and what margin means and what it does. They should dissuade it. They should up it even more to dissuade people from buying this kind of stuff on margin. This is kind of crazy. So I'm surprised it was even at 30% in the first place. Like,
it was 30 and then they increased it to 40. So I guess that just shrinks your available margin without you knowing, right?
Of course, yeah. It depletes it depletes that margin. So let's just say you remember in a 100% allocation, by default you're at 30%. So you contribute, let's say dollars of a $10,000 portfolio. That's the minimum you need to contribute, and the broker provides $7,000 of a $10,000 holding. So when that margin requirement increases, it sets the bar higher to the amount you need to maintain in that relationship. So you're upping that by 10%. So you need to be adding more, basically. Yeah. If that falls.
But like I actually had a question for that. So like
Sure.
um
Knock yourself out. We're talking about margin here.
if I
Everything.
wanted to buy more MST or something, yeah,
Sure.
let's just use MST since we're
Sure.
talking about
Let's do that.
if I want to buy it, but I didn't want to buy it with margin, so
Okay.
I opened another cash or non-registered without margin enabled,
Yeah.
so I can then buy MST in that account with cash. But like, I was wondering, is there like what's the benefit of that? Because if I bought it within my margin account, right?
Yeah.
I know it's not a good idea to buy with margin, but like, but then if you hold it there, at least it's contributing a little to your available margin. Whereas
It's
when it's
contributing
over
both
there, it's
both
not.
negatively and positively at the same time right now. So it is technically adding more. So it adds to your margin availability, overall
Yeah,
amount you're borrowing every time a distribution comes in. But that stock price decline takes away from that overall margin availability, and that will actually contribute more if that margin requirement ups even more from that 40% margin requirement to 50%. Let's just say, for example. So you're subtracting 10% more overall to what you have available. So
yeah,
clearly you can just have that one margin account as your non-registered account and buy MSTE if you want to. This is not clear. Remember, folks, this is not financial advice. This is just education. This is just this is entertainment purposes. We're talking about Leon's own strategy. He knows the risks of buying
yeah,
MSTE on margin. So we're just going through those risks that you need to be aware of. And so going back to the topic on hand. So remember how I mentioned that when you buy stuff in your margin account, the broker makes you buy everything in your own money first.
yeah,
So when that happens, just say right now, because if you didn't borrow anything on margin yet, and you added more money to that margin account, then
yeah,
that does not affect your overall margin availability with the broker. So if you let's just say, for example, you had nothing borrowed from Wealthsimple, and you added $5,000 to that
yeah,
account, and you use that $5,000 to buy MSTE. Well, that doesn't affect it won't cause you to be any sort of margin call, but it still might affect the overall amount you can borrow because it's taking everything in consideration in that account, regardless whether or not you're borrow anything. So keep that in mind. So, and in this case right now, if you were to open another regular personal account, not on margin, and buy MST with that, that has no effect to the amount you can borrow on margin.
yeah,
So that is completely separate because they're not tied together. They are completely separate. And so in that case, in that specific scenario, you can do whatever you want with the MST. There are still risks, but the risks are less compared to if you were to buy it on margin per se. But say, for example, you were to add that $5,000 instead of buying MST with that $5,000 allocation in your other non-registered account, and you were to just add that $5,000 to your margin account. Guess
yeah,
what? You can't use that $5,000 separately to buy MSTE. That $5,000 you added goes towards paying off your borrowing
yeah,
cost
yeah,
first. So it
right.
depletes the amount you've already borrowed in your Utes, in your SDAY, in your BIGY that you've already borrowed on margin. It
Yeah, yeah,
decreases
that
that.
makes
So you're
sense.
basically paying off your capital first.
Yeah,
So when you buy MSTE with that new account, it's going to be on margin. So you're borrowing from the broker to buy that, which is, no, I mean, it's
yeah, I
from a,
know.
from a, from a, from
I
a, tech,
understand.
from a
So
technical perspective, as long as you keep that MST allocation relatively small overall in that margin account, okay, then do whatever you want with it because you're retaining your risk. You're spreading out your risk.
yeah,
You're diversifying the chances of being margin called, even though MSTE per se specifically, well, anything related to strategy. So you can have MSTR directly if you want. You can have the DDR version MST if you want. You can have MSTY from YieldMax if you want. You can have MST from Defiance if you want. Like anything related to strategy. You can have that strategy allocation in your margin account. But you just have to be aware of, if it's a huge chunk of your margin account, it will dictate the amount of borrowing you can have access to, and you're that much closer in a market correction to being margin called, even by like $1. Keep that in mind. You can be margin called even in $1. So just keep that in mind if you were to do any sort of single stock allocations in your margin account. Was that clear? Yeah.
Yeah, I actually found that out just like doing some trial and error on my side.
Mm-hmm.
Basically, yeah. If the long story short is, if you have a negative balance in your margin account, that means
that just means you're borrowing
because it's negative. And then if it's negative, you can't buy anything with cash.
Then there's no cash. You don't have any free cash, basically.
Yeah, if you put cash in, it'll just automatically pay off your margin.
Yeah, which is actually smart for Wealthsimple, because it means that they're actually smart by doing that. So it knows that they're going to be taking back what they borrow against you first. So they're actually, it's smart on their part that it's an automatic repaying of the loan per se.
Yeah. What's cool is that I didn't know, like, you can actually transfer your unused margin to your...
It's like a line of credit. You can do anything with it.
Yeah, and then you can withdraw. I'm not recommending that, but you could do that.
Okay, let's just... I'm thinking about doing that. That's why in the near future.
Yeah, it's
so
like
I don't know if you saw that. I don't know if you saw that since yesterday, Saturday, both Paul and Perry released their second coffee podcast of sorts, and Paul didn't mention me clearly in that list of people. That's also, I guess, I could be one of the influences of why he opened. I could be. Don't know if that's don't know if that's the case. Concrete example per se. If that's the concrete example per se of why he wanted to open a margin account, we could just say maybe. And he said that I have a relatively large margin account in my overall portfolio. And the reason behind that is, well, guess what? The world is run on debt. And the wealthiest, obviously, use debt to buy more debt, to buy more assets. They use debt to buy everything, because guess what? Everything on debt is a tax write-off within reason. Yeah, it's a tax hit within reason. You can't tax something if it's on a loan. You can only tax something if it's something you own, right? You can't tax a loan, so it's a write-off. It's a tax write-off. So, barring that in mind, if I grow my margin account even more, let's say in 5 years, let's just say, for example, in 5 years, that margin account itself grows to like $1 million. It's not right now, obviously. We're just using that as a very far-fetched example. Far-fetched or not, let's just say, for example, that margin account grows from that $300,000 now to $1 million in 5 years. Well, guess what? I don't plan on staying in Canada long term. Well, what's the next plan? Start using some of that margin. If I'm allowed to, because I will probably be snowbirding part-time. So I'll be probably working part-time here to maintain that legal status from a tax perspective in Canada, and going elsewhere, exploring other adventures, because, well, guess what? Nothing is tying me down here. I can do whatever I want. I don't have a real estate property or anything concrete that's tying me down here from a mental perspective that I need to be here. Well, as my business expands and more of it is digitized and everything goes online, well, guess what? What's the beauty of that? Flexibility. You can go anywhere you want. And you can't do this right now. So Wealthsimple has limitations in terms of how long you can stay overseas while accessing your accounts. They are not from right now, as of this current moment, they are not very friendly in terms of expatriates or non-residents. So there are limitations in what you can do with all your accounts, whether that be your checking accounts, your savings accounts, your investment accounts, both managed and DIY. So there are limitations in what's being done right now. And I don't necessarily want to transfer to Questrade because even though Questrade is another good option, another commission-free option that that has more or less the same advantages and disadvantages with Wealthsimple. But the one main advantage with them is that they are more friendly from a expatriate and non-resident for tax purposes.
Yeah, yeah.
You can use them overseas. Well, guess what? Adriano is a clear example of
Yeah,
that.
Adriano uses that.
All of his accounts are tied to Questrade, and he's full time in Panama for about 3 years now. So, and Questrade doesn't care. He can clearly do all his managed investing on that platform.
Yeah.
Well, one of the downsides with Questrade is their margin borrowing costs are way higher than what Wealthsimple offers. So it makes no sense. Let's just say right now, Wealthsimple overall, on average, is about 4%. Questrade, you're looking about double. Give or take. It may or may not be, take what I'm saying right now with a grain of salt, but it's more aligned. It's anywhere between 6 to 8%, which is 2 to 4% higher. And from a compounding perspective, the higher margin costs you have, the less wiggle room you have in terms of borrowing, which also includes withdrawals. Because if you want to withdraw and you want to live off your margin accounts, you need to be more smart, and you need to finesse that account with less that you're borrowing with, because every withdrawal contributes to that margin availability. Arguably even more, because guess what? Every time you withdraw, that's 100% margin requirement. So I don't know if you've noticed yet, but I started playing around a little bit. Every time you start buying securities with that account, depending on the margin requirement of each individual security, that margin availability goes down, not a 1-to-1 scale. It could be a 1 to half a scale. It could be a 1 to 0.33 scale. So it goes down, that overall margin availability that you have access to goes down less than 1-to-1, depending on the margin requirement of each specific holding. And so, but that is not the case when you withdraw it from that account. So if you withdraw $1,000 from that account, either to another account separately, or withdraw as cash completely to another account, to another bank account, that decreases exactly by that amount. So that 1-to-1 scale. It's as if you're buying something on 100%. It's as if you're buying a security at 100% margin requirement. So you're taking off. It's an exact 1-to-1 scale. So if you want to live off your margin account, you need to be more. You need to finesse it more in terms of the margin borrowing rates that you have access to. Because remember, what margin interest rate that you have access to, it accumulates every month. Because right, interest gets charged every single month, so that automatically decreases the amount of margin availability you have every month. And if you want to also withdraw from that account, well, guess what? You need to finesse it even more. So that might be something I will be looking into, and may start experimenting with. Just a case study, just to play around with it before I actually start stimulating actual withdrawals, if I want to. Yeah.
So
yeah,
your plan is you want to keep your margin account like for as long as you're investing
forever.
Okay.
That's what the wealthy do. Come on.
My original thinking was like with my margin account, just to
You want to pay it off?
Yeah, just to accelerate for now, and then
why would you want to do that though?
Down the line, when I'm gonna withdraw, then I'm gonna probably pay it off slowly through my monthly withdrawals, and maybe a portion of it.
Okay.
And then eventually just not have to think about that. One less thing to think about.
Sure. Are you debt adverse or pro debt overall?
I don't have any other debts, I think. Well,
you don't have any
debts, but not too many.
Let's just take your student loans example. For example, are you I'm assuming you're in the repayment period, right?
Yeah.
And so here's a good example. Are you stretching out? You're in Ontario, right?
Yeah.
Just to make an example. And so I'm assuming you have OSAP, right? So the Ontario
Yes.
Student, I forgot exactly what that
Assistance
acronym
program.
is. Ontario Student Assistance Program. Yeah.
Thing.
So and it's roughly about, I think, 90% from federal loans, and then 10%, I don't know, 10 to 20% is from Ontario, but it's combined, right?
Probably
Provincial.
something
Yeah. So
around
they're
there.
combined together. And I have loans from OSAP as well. So this is because I just took out the loans when I was doing my undergrad. So I had that with OSAP. It was just way easier to deal with than with Quebec in general. Everything in Quebec is way more complicated. So it's just way easier to maintain residency Ontario while I was borrowing. And so going back to those to these loans, in terms of viewers, be in mind that in Canada specifically, federal loans are at 0% interest.
Yeah,
For
it's
now.
really nothing.
It's interest free. You're paying nothing. And Ontario loan and the provincial loans are tied to the overnight rate from Bank of Canada.
9%.
And so you're basically getting the overnight rate plus, like, I don't know, what is it, like 1%? Something like that. I took at the exact borrowing cost this morning because I have loan repayments. I started paying a little bit off every single month, just to decrease the very minimally. So I have minimal payments to that, because guess what? I could be making so much more.
Yeah, there's no rush.
I can make so much more in the stock market. Well, keeping, within reason. You don't want to like gamble on that, because clearly you're gonna lose.
Yeah.
You're gonna lose everything, right? So don't do that, but do it smartly. So going back to the topic on hand, we have federal loans at 0% and provincial loans at right now 5%, give or take.
Yeah.
So from an overall combined perspective, the overall interest rate in total is around 1%. 1% loans. Where can you get 1% loans right now? If you're borrowing from a line of credit, you're getting like what, 6%, 7%. If you're borrowing from margin, you're at 4%, 5%, or higher. So around that line of credit range, if you have a margin account with a big bank, for example. Yeah. And so that student loan. So let's going back to the question: are you maximizing your payments?
No.
Are you like basically fast tracking your payments to that, or are you minimizing your payments and investing?
I'm doing the minimum.
The difference.
I'm doing minimum.
You're doing the minimum, right?
Like
well, guess what?
A month.
Those interests that you're accumulating, that being what, like $1, like maybe like $30 a day.
Yeah, it's
that portion is write-offable. You can write that off.
Yeah, true. I remember seeing that.
You could only write that off though. Actually, I might have to double check this, but any sort of interest that you're accumulating for your own business, that's write-offable. But that might not be the case if you're only a W-2 worker or a T4 worker or a regular employment. So that may not be the case. I don't know if that is the case for you. But were you able to write off your student loan?
I think I remember on my tax return.
Okay.
Claiming something about like student loans, but
okay, cool.
I could be wrong.
Okay, actually, you might be correct then.
Taxes on Simple Tax. It's pretty nice.
You file your own taxes? Yes, finally, someone to talked about what.
Yeah, you're the tax expert, I heard. So, yeah.
Well, everybody refers to me as a tax expert. I am an unofficial tax expert, but I am looking into completing like actual certifications with H&R Block to become a certified tax accountant.
Yeah.
Down the line, because I am unofficially helping, friends, helping family, helping friends of friends file their taxes. Because since I am a generational client, well, guess what? I get to file 10 tax forms per year for free.
Yeah.
With Wealthsimple.
But even
guess what? Might as well maximize. Why doesn't matter, right?
Even if you're not like generational, I think you get like 3.
Or
like
I was
2.
a premium client. You get 4 per year for free. Yeah. For a core client, you get 2.
Yeah, that too.
Which is completely fine, like for you. Like unless you can do one for yourself, you can do one for your spouse if you have a spouse, You can do one for your common law partner if you want. You can do one for a family friend. You can do one
Yeah, and
for
then
your parents.
my mom wanted to file, so she just opened a Wealthsimple, and then we filed.
And then if you want to do more, it's like what you pay like $30 and you get to file like 6 more, something like
or
that.
you can open up a new account.
You could do that too if you want.
Yeah, well,
There's no limitations.
Now my mom uses Wealthsimple, so they gained a client, I guess. That's good.
All right, so yeah, cool. So going back to this loan topic, because margin is a loan. So if you're basically treating the same as student loan payments and you're investing the difference, why do you want to fast track and pay off that loan faster? What does that get you from a mindset perspective?
I don't want to pay off now. I want like down the
well,
line.
I know you're slowly paying like. But so I think the way it was formulated, will you be buying more on margin moving forward?
Yes.
Or are you going to be basically not do anything in that account and let the distributions collected every single month slowly pay down that capital until you reach 0 and you just own what you own instead of the broker owning like half of it per se? What's your plan moving forward? Because like when it comes to investing, when it comes to any sort of anything that you want to gain value, margin is simply a tool to get there.
Yeah.
You just have to manage it properly.
Yeah. So no.
So okay. So audience. So clearly today's first episode, we're talking all about margin. We'll go through taxes and everything else, even side hustles, even refraining that mindset shift. Maybe advances in your career, building, other sort of avenues. We'll discuss all of that in another episode. But today's episode, I guess we'll focus on margin because that's a huge, it's a hot topic, right? So
big topic.
Yeah. And we can't cover that just in one episode because it's an ongoing series that will, it's all about the mindset moving forward. Because right now you're just starting. I'm basically providing unofficial advice to you because I've been doing margin for about 2.5 years now, and even prior to that, my parents they have an investment property, mortgage from a bank as an investment property. Even your principal mortgage, all of that is margin. That's not necessarily margin, but it's borrowing
money.
Everything is borrowed money. Well, guess what? The world runs on debt.
Yeah.
So that's not going to go away.
Yeah.
Guess what? The wealthiest don't buy stuff with their own money. They buy stuff with other people's money and they write off the difference.
Exactly. It's like Elon Musk.
It's the same thing.
He bought Twitter with all his.
It's just the amount of scale. It's just the amount of scale you have access to is different, but the concept is more or less the same. You need to think. It's all from a mindset perspective. You need to think like the wealthy in order to become wealthy. You can't have a broke, poor mindset and think you get wealthy by having that same mindset. Guess what? You'll stay in that bubble. Yeah. You'll stay where you are. Your mindset changes and adapts when you move up in that social ladder. It has to. Otherwise, you're going to be doing the same thing over and over again and nothing's going to change.
Yeah.
Right? If you don't adapt your mindset, even if you get money in that account, if you don't change your mindset and adapt to your environment, to different market conditions, well, guess what? You're no different than just pulling out everything during a market correction and selling it and using it and then storing it off in a bank, and you're losing power because inflation is so high. You're effectively just losing buying power. And guess what? In retirement age, if you don't change your mindset and do what is beneficial now, you're going to be broke ass for the rest of your life. You're going to be working until you're 100 years old. You're going to be forced to work until you're 100 years old, not by choice. You have to in order to survive, because everything is going to get even more expensive moving forward. Inflation is going to keep going up. Yeah. It's not going to go down.
Your paycheck.
Guess what?
Not enough.
The world is run on debt. Everything gets more expensive. Everything loses buying power every single year. Well, you need to get with that game. You need to do the same thing. You need to invest with debt if you're able to, in order to keep up with the game and do more. Otherwise, you will be staying at that same bubble and nothing will change. And guess what? That's your fault.
Yeah.
That's your fault, basically, for not changing your mindset.
We got some good
Right? That's a wake up call. It's a wake up call. You have to realize it now to change and better yourself, better your family, become more financially aware of what's possible. Because the end result, the end benefit is you and the closest people that you are with.
Yeah.
So there's that.
You got
That's
some
probably the
good-
most important lesson from today's episode, I guess.
Yeah. Very good. Very good. I don't remember.
We're talking about loans and your overall mindset's perspective into how you want to treat that margin account.
Well, right now I'm continuing to buy on
Mhm.
my margin account. Like every time I get paid from work, I'll contribute to my non-register, and then since that cash will also increase. Well, it won't increase. It'll pay off my margin, and then
One other
bought
little
assets.
one other little tip that I wanted to mention right now. Since do you have any other side hustles besides your main employment?
I walk dogs.
Okay.
But
Do you declare that
not
income?
really. No, it's not really.
Do you declare that or do you not
No.
declare that? Okay, if you don't,
It's just a little thing in the community.
well, technically it's a side hustle. Technically, don't quote me on this, but you might want to speak to your tax accountant in case for other viewers that are listening in this specific example. But in Canada, any form of side hustle counts as self-employment income, and anything that you do with that business, because now you also have a YouTube creator, so that is a form of self-employment.
Oh yeah.
So anything that is related to that is a tax deductible event. Guess what? In Western Hemisphere, in North America, that we are basically refraining about, who has the best tax advantages? Not the regular worker, clearly. Self-employment.
Yeah, self-employed. Yeah.
And any side hustle counts as self-employment, which means that within reason, within legal refinements, anything that you use for that self-employment is a tax write-off because you contributed to that business. So your phone, your hydro bill, your food, your phone bill, whatever you want to think of that you're using for your business, that the amount of time that you're using your phone, and because you're using your phone when you're walking dogs, you're using your phone to connect with clients, you're using your phone to write advertisements, to put yourself out there in the world, to brand yourself. Guess what? All that time and effort and money that you spent into your own business is a tax write-off. Use that to your advantage. That'll help you with your savings. So young people, remember that in Canada and North America, self-employment, whether that be from a sole proprietor, you are your own business, or even from a corporate ladder perspective, like if you have an incorporated business, that has its own legal refinements that you definitely need a corporate accountant to deal with. But from a self-employment, where if it's just you run your own business, if it's you and a partner run your own business, from a smaller scale, everything within reason is a tax write-off, and you can prove it.
Yeah, ever since
there you go.
Talking with you,
second nugget of the day.
Yeah, ever since talking with you, I've been paying more attention to that, and
you have to.
Yeah,
we pay. I don't know about you, but we pay a crap ton of taxes without any benefit, without any fruitful benefits that we're receiving.
Yeah. So yeah.
Why are we paying this? What's the point?
Yeah.
And these are legal loopholes you can use and refine, because guess what? All these tax savings that you are able to claim back betters the Canadian economy in some way or another. So
yeah, so I'm looking into that for my YouTube, but then
food for thought.
For the dog walking thing, that's just like once a week or something.
Hey, I mean, you use your own time, you use your money for that, so that's a tax write-off.
Yeah, but it's more like I just get a walk and exercise and whatnot. But yeah,
But for YouTube,
I'll look
okay, for
into that
YouTube
for my
specifically, because you are now treating YouTube. Well, guess what? It's a consistent small business.
yeah, my YouTube for sure. I'll look into
All the
that.
equipment that you've paid for, your filming equipment, your new microphone that we're looking to right now, your headphones, your if you're using a laptop per se, well, if you're using a separate laptop that you bought specifically for YouTube, that is a tax write-off. Well, not the entire value, because that is a capital expenditure that you will be using, long term for your business. So it's not like you're taking that value and the value is gone within the same year. If it's a long-term investment for your business, then there's more loopholes and complications that you have to basically use a depreciation calculator to determine how much of its original value you can write off in that specific year. But
Yeah,
technically speaking, anything that you use for your business is a write off.
yeah, cool. All right. Well, looks like
Let's talk about more about your margin in your and what is your long term plan moving forward.
yeah. Keep eye on margin. Accelerate my distributions.
Mm-hmm.
Maybe I can pull in an extra month or two of dividends earlier, and then I haven't decided if by the time I want to actually start withdrawing, maybe in 30 years or something.
When you move out of your parents' house.
And then maybe I'll keep the margin now that you're like advising me that because
Well,
originally
unofficially, right? So
yeah, originally I was thinking of paying down the margin, but
you
we'll see.
if you are debt adverse and you don't care, you don't like debt in any manner, which includes both high interest debt, which if we're talking about high interest debt, anything higher than 10%, then
Yeah,
fast track that payment because you're not gonna win. You're not gonna beat the interest rate in a
yeah,
stock market
true.
long term. So, but anything less than 10% in that is in that gray scale that you can finesse
Yeah,
technically.
yeah, the
And
margin
when it comes to
yeah,
student loans at 1%, if you are fast tracking those payments, well, it's your own money. But I have to say that you could be a big buffoon if you fast track those loan payments.
yeah, yeah.
If you don't know
And
what you're doing though. But yeah.
yeah, and one small thing for student loans, you can actually write a check to pay off the provincial
You
loans
can, yeah.
at the beginning, so
Apparently that's a
there's no
thing.
debt. So I mean, so there's no interest.
Did you do that?
I didn't do that because I have very little in provincial, so there's no point. I gain like a few cents a day in interest. So yeah. I probably the time it takes to and the energy to find a stamp and mail it,
Yeah, they make
it'll
this
probably
whole
take
process
more.
very complicated. I was actually looking at that for a while back, and someone on Reddit actually provided an example. But I'm just like, is that really the case? Like, what if it's wrong and you mailed the wrong address and you gave money away,
Yeah,
and it's like it's too much of a headache. I'm just like, for that 1% interest, an amount I could be gaining because that interest that I'm accumulating is a tax write-off because I am actually investing in my own business, because not all of it is going to investments. Part of it is going to investing in my own business. And so all of that, from in my case, is a write-off
yeah,
because, well, I'm using debt to for future value. And
yeah,
so it doesn't make any sense for my example. And it's a huge headache. So I'm just like, until there's an actual definite way that you can actually do it online on the loan payment portal, I'm who writes checks now? Jesus Christ, we're in the late 21st century. Who still writes checks now?
yeah, yeah. I got my Wealthsimple checkbook once just for memories.
Okay.
Yeah, but I haven't written any checks. Cool. Well, it looks like we're just about over an hour, so maybe we'll
Final questions then for why did you want to buy Biggie in SD in your margin account because they are still going to be at that 50% margin requirement,
50%, yeah.
which is even higher, surprisingly, than MSTE.
Yeah,
So why do you have those in your margin account? Just from curiosity perspective.
More so
Do you
because
need it?
I was like this. I probably bought it when it just enabled margin, and then I was treating that account like my non-registered, and like I had those in my non-registered,
Okay.
and like I could buy it in a separate non-registered account with just cash, but then like it won't be adding contributing to the available margin
Okay.
I can use, right?
Sure.
So, and it's not that it's still kind of diversified like SD.
BIGY
So
is not.
BIGY is more concentrated, yes.
BIGY arguably is more aggressive and higher risk than HHIS.
Yeah.
And remember, HHIS is at 30% margin requirement.
All right,
BIGY is
yeah.
not.
So I'll probably change up the
Arguably
weighting.
speaking, because of how stable SD is, because remember, any ETF wrapper is just an ETF wrapper on top. It all this applies to anything, whether in the cover call ETF space or the regular ETF space or any closed end fund. Everything is a wrapper and everything depends on the underlying holdings. And so looking at the underlying holdings of SD, what are they? They're a bunch of high blue chip, high paying dividend value stocks, basically that
Like
barely move
McDonald's.
that barely moves in price, even during market corrections. Well, if that's the case, SA is going to do the same thing.
Yeah.
That does not mean it will perform better total returns perspective than holding the regular S&P 500 because you're missing that growth chunk, that 35% tech exposure in S&P 500. So long term, if everything is to scale, dividend companies will not outperform the S&P 500.
Yeah.
Well, guess what? Where's the growth? You're paying dividends. Where's the growth?
Yeah, it's more a
right?
defensive play there.
Exactly. So actually, now that we're touching on SD, because I have my TFSA as collateral with my margin account, and right now my TFSA account is a bit more tech is a little too high in terms of risk exposure.
Tech focused.
It's a bit too high tech. It's a bit too tech focused than I would like to because I also have crypto in there. So I have HBTE in my TFSA, and so because of the fact I want because my TFSA is also fueling part of my margin availability in my margin account. So I actually, in my case specifically, I need to decrease the risk I have in my TFSA. So that means I will be, because I have BIGY in there, I have YMAG in there from YieldMax. I have a little bit of Coney in there. I have a little bit of Misty in there that I bought from a year and a half ago. I have Canny in there, the new one from Evolve, just a little bit. I have BIGY in there as well. I have a huge chunk in HHIS, and I have UCL and USCL in there. Oh, I also have the new 9-point ECHI in there, which is the same thing as HHIC.
HHIC.
Exactly, which is a Canadian version of HHIS. So I actually swapped the rest of my ENCL holding, which is the oil position, because oil is pretty volatile and it's kind of unpredictable in terms of stock price and volatility. So I cannot have that in my TFSA when it's contributing to my overall margin availability. So I sold that off and swapped it to ECHI to be a bit more defensive. And so moving forward, I need to actually bring those Daymax positions back into my TFSA, and it needs to be more Canadian focused as well. So maybe 50-50 in my case, specifically because I had that linked to my margin account. If it wasn't linked to my margin account, then I don't care. Then it can be as US tech focused, and I want,
Yeah.
Higher, technically US tech focus, higher risk, higher growth potential, especially very long term if you're looking at 15, 20, even 30 years. and from a long-term perspective, because all the growth potential, guess what, is in the tech, is in the AI, is in the semiconductor space. Not in the Canadian space, clearly. So we have very little in terms of tech. All we have is Spotify.
Right.
Sorry, not Spotify, Shopify. And so yeah, so in terms of that overall allocation, because for my case specifically, I might actually bring HDIV back as well. I'm still considering the possibilities,
Yeah.
but in terms of that sector mix, I will add, because I don't have HYLD in my TFSA. I will bring that back to my TFSA. I may or may not bring HDIV back into my TFSA. I will add more to ACHI. I will sell off Kenny, because higher leverage does not necessarily mean lower risk. It means higher volatility, and I don't want that in my TFSA. So I will be selling off Kenny eventually. I will be selling off BIGY eventually, because BIGY is the same thing. Arguably speaking, BIGY, because it's focused on tech, it has higher volatile potential and higher risk than Kenny. Because right, Kenny is 50% in financials. Well, it's not that volatile compared to tech, and so both Kenny and BIGY will go eventually. I will be selling off or trimming down my HHIS allocation. I will keep QQCL as is. The original plan was, when I was talking to Gary about 2 months ago, when I mentioned that I wanted to swap out my entire USCL position, because USCL makes up about 60% of my TFSA. The original plan was I didn't want USCL anymore because it might be too boring. And so the original plan was sell off USCL and go into HHIS, QDay, and QQCL. Tech focus. Swap that out. It makes sense if you're trying to maximize growth potential in a income focused product line. But that would that technically would work very well if you're just growing out your TFSA and you don't have that much capital, maximize your growth potential. But in my case specifically, going back to the fact that I need to be decreasing the aggressiveness of my portfolio, increasing the defensiveness and risk adverse potential of my portfolio, I will technically be trimming down USCL a little bit and go more into Canadian. So I don't know if I want to add SDAY to my portfolio. I might. I'm debating. I'm not clearly QDay is not going to go into the TFSA, because QDay is arguably just as high risk as HHIS. Exactly, because it's all tech. So that is not a good candidate for my portfolio specifically. So the candidates on my line in my TFSA specifically would be add HYLD back in that portfolio, add HDIV back into my portfolio, and maybe SDAY, and add more to CHI. So we're trimming down USCL, HHIS, and adding that to my portfolio overall. So yeah. Do you have any thoughts on that?
So like USCL is
entire S&P 500.
Entire S&P 500, and then if you just trade off for SDAY, that's just 35 dividend companies.
Yeah.
Right.
But remember, you're removing all of the fluctuations of the S&P 500.
Yeah.
Right? Because you're removing the REIT allocation of the S&P 500. You're removing the consumer discretionaries from the S&P 500. You're removing the tech exposure from the S&P 500. All you have are the blue chip dividend growing companies, which don't move that much in price. Arguably speaking, they would be performing better in market corrections. Well, right? Yeah. It's a defensive sector. At the beginning, when we were talking about which defensive sectors would investors flock to during market corrections, high dividend paying companies, that's one of them. Consumer staples, that's one of them. Utilities, that could be one of them. Financials, maybe not. We don't know, because financials, it's kind of a blue area, so it's its own sector. And so consumer staples, what was I saying? Oh yeah, consumer staples, dividends. Consumer staples are essentially the dividend growing blue chip companies in this S&P 500. That is what SDAY holds. So arguably speaking, it is less volatile and more defensive than holding the rest of the regular S&P 500. So SDAY could be going down. Theoretically speaking, SDAY would go down less than USCL. Because technically SDAY is not it's not leveraged in the same sense that USCL is. Because remember, USCL is also leveraged. It's 25% leveraged of a 25% leveraged version of the S&P 500. So it has 25% more down. What's the term? So it will go down 25% more than just your regular SPY, your regular VOO, your regular VFE S&P 500 without any leverage. It's going to go down 25% more. But SDAY is not leveraged in the same sense. SDAY 100% is in those dividend growing companies. 25% is on options at the money cover call options on the S&P 500.
Yeah.
Well, what in market corrections, when implied volatility, the entire market goes up, you'll be doing better from the options perspective, which will actually decrease the NAV falling even more. It will help stabilize the overall NAV price even more. So with all those factors into play, well, this is clearly all based on theory, but SDAY doesn't. If you look at the stock price of SDAY doesn't really go up when the entire market goes up. SDAY does not fall either when the entire market goes down. It does not move in the same sense. So it's kind of flat.
It's just
also
paying that consistent yield.
It's playing at, what is it, 17%? Yeah, so 17, 18%. So it's almost like you're buying use.
Yeah.
Well, not quite, but and almost in the same line. Yeah.
Yeah, I like it.
It's a very defensive play, but you will not grow your money as much with SDAY compared to USCL from a long-term perspective. It's a purely defensive play.
Yeah, but then maybe since you have a big allocation to SDAY, it's defensive, then you can go more on the aggressive side and get the HHIS or BIGY or whatever, and then capitalize on that growth over there instead of the traditional S&P 500. So that's a thought.
Food for thought. I will be doing more allocations and trimmings year end before the end of the year. And what that may mean is, from a tax perspective, still thinking about it, but I might make some more moves in my margin account specifically. I may get rid of my rest of my 0.1% in Coney and MSTE that's still there.
Nice.
I might do that. I don't know if you've noticed, but in my FHSA specifically, I've actually started adding to HEQL. You know what that is?
Total equity.
Total equity, yeah. World index, yeah.
Yeah.
So that's because FHSA, long-term horizon, you can't really do much with the dividends anyways. Everything goes back to reinvestment. So with that accounts, because right now, in terms of that account, I have so many different holdings and I'm trying to simplify it more, which means that I will most likely, in terms of that account specifically, I will trim it down to maximum 5 positions that might be equal weighted. So which means that HEQL is one of those core holdings I will be adding to. QDay is one of those holdings I'll be adding to. HHS, increasing the allocation. In terms of the other holdings, I won't discuss it now because clearly I haven't made those moves yet. So it's just pure speculation. I have to, make some tweaks here and there just before year end. Which also means that, because I also have a separate FHSA with Questrade that I couldn't move over, it's stuck with Questrade, and I have a bunch of yield max products in there. So in terms of food for thought, that's going away. Yeah, getting rid of all that. So yeah, there's that.
Cool.
Yeah. Last thoughts before we end this first episode.
Oh, just don't for viewers, if you guys wanna try using margin, like
Go
first,
all in on
if
Tesla.
you're big, sorry.
Go all in on Tesla.
So first, don't touch margin if you like just starting, right? Like,
Yeah.
margin's like it's just there's a lot to learn. So I wouldn't even worry about that when you're starting.
Mm-hmm.
When you're starting, just like as in our talk before, I said just buy a broad index fund and then get your foot into, or like dip your toes and get your feet wet into the market.
Mm-hmm.
That should be your primary concern right now, not margin. And then maybe once you're more comfortable, then you can make sure to do your own research and learn about how margin is working, then go from there.
All right. Sounds good.
Yeah.
Very wise words. I'll just add to the fact that learn about walking before you start running. And so
Yeah.
when it comes to margin, you're basically at the flying step. You don't start with margin when you don't even know the basics of investing. You start learning the fundamentals of investing, what a stock is, what a distribution is, what a dividend is, what are the different indices that are tracked in the world, what is an ETF, what is a broker, how do you buy stuff, and what is your overall. Start dabbling in broad-based indices for the start, and then go more thematic once you've grasped the basics, once you've harnessed what it means to be an investor and not a gambler/speculator. So learn the basics before you start adding risk to your overall financial portfolio. So I think that would be the main lesson here, the biggest takeaway. And yeah, do you have any other thoughts before we end this first official co-creation?
No, I think that's good. We have some more topics, but
Food for
we
thoughts, yeah.
always talk about that in future episodes.
And it will actually be. In future episodes, it wouldn't just be us. It would. We would have other guests
We'll
on.
have guests, hopefully. Yeah.
Sounds great. And so, viewers, keep in mind that clearly at the very end, we have to mention this again, just to hone into the key points, that today's episode, everything we've talked about, is clearly on an entertainment and educational perspective. We are not licensed financial advisors. Everything is based on personal experience, personal food for thought, and what we will be doing moving forward in our own portfolios, and just showcasing our own journeys moving forward in this rapidly changing environment. And take the nuggets that we've spread out throughout this entire episode for your own learning journeys, and share. And investing, gaining knowledge, everything is a positive sum game, which means that everybody wins together, everybody grows together. And so that, I think, is the most important key takeaway. And yeah, so that's it for this first episode of Beyond the Paycheck, and hope you all enjoyed this episode. Share it with anybody else that you find found helpful in any way. And in the next episode, we will talk more about our ongoing and margin journey, taxes, refining that paycheck, getting and keeping more from that paycheck. And so, yeah. Hope everybody enjoyed this episode, and we will definitely see you in the next one. Bye for now.
See you guys later.
Take care.